Oop, can you guys hear me? Okay, let's talk about my background. So I've spent the last 25 years in private equity. The space that I play in is called lower middle market. Lower middle market is, companies that range from, call it 25 million to 100, 150 million dollars in revenue, maybe 2 million to 10 or 15 million dollars of EBITDA. The companies on, the smaller side of the scale. When I'm getting into businesses, it's called first institutional capital. These are, families that really haven't had a succession plan, and they're trying to take chips off the table for their retirement. And private equity has seen something in their company that they can grow it. And that's basically where I'm coming in with the private equity post-acquisition, sometimes during the due diligence process to help them through that. I've had 2 successful PE exits, 3 recapitalizations, and I've brought a bunch of companies to either LOI or definitive agreement in that. The way this talk came about is I was having some conversations in the room, and I was talking to people about how different it was back in 2000 for private equity versus being an operating partner in private equity today. And one of those real differences is what you'll see in this Venn diagram. There was a clear separation between ownership, the GPs or the private equities, and the operating partners, and the management team. Today, for reasons that we'll go over in this presentation, there is a really clear overlap between the GPs, the private equities, who are really inserting themselves as owners in the company, in the management. And, what we'll talk about is how that works firsthand. So what is private equity? Really, it's this $8.2 trillion market. That's there. It's pooled investments that a fund acquires. So they'll raise a fund. It might be a very specific fund. For example, we're going to raise, $500 million and invest in aerospace companies. And we're going to hold that for 10 or 12 years. And so when you're getting into these funds, there's really no liquidity or very limited liquidity for a long period of time. There are today 11,500 platform companies in the US. Now, that's just platform companies. That's up from 2000, where there was only about 2,000. So when you talk about platform companies, it doesn't include the bolt-on investments. If you talk about bolt-on investments, today there's probably about 25 to 35,000 companies that are involved in PE through those bolt-ons. If you're an investor, your portfolio probably includes some institutional funds which play in this marketplace. If you're a lawyer, a banker, a business owner, a wealth manager, basically you're touching this industry in one way, shape, or form. Just to give you some other numbers here, of that 8.2 trillion, 600 billion was the 2000 number. So a 15x growth rate. And the other part of this and why private equity has really kind of exploded is the fact that the number of US public companies has declined dramatically over this time period. So back in 2000, there were about 7,000 public companies that you could invest in. Now there's about 4,500. So if you think about that, and your 401k or your investment opportunities have really diminished and are, far more narrow today than they were 20 years ago because you don't have those additional companies in the public market space to invest in. So why this matters to you. So for investors and wealth managers in the room, what you're finding this is that the selection that you have, if you're choosing private equity firms, is more important than ever in this market. Between 2000 and 2010, the early stages of this, there was really a rising tide in the marketplace where you could just perform some financial engineering and you would buy a company at 8x and sell it for 12x. Kind of like, if you bought a house in the right neighborhood, and the market just kept increasing, you got those increases whether or not you fixed the plumbing or you didn't fix the plumbing, right? And that was a lot of the early days of private equity. Buy a company, lever it up with debt, um, use this rising tide, buy it for 8x EBITDA, sell it for 12x EBITDA. Everybody was happy on that. Today, if you're a wealth manager, you really have to be careful on the private equity companies that you're investing in if you're in that case. For business owners, that PE firm that's offering you a term sheet, you really have to do your own due diligence on it because from what you're seeing today, that PE firm might not be around 5 years from now. There's this thing called the zombie effect, which we'll talk about, which would play, into your decisions on if you go with them on that term sheet or not, mainly because you're typically rolling over equity or you're taking an earnout. And if they're pretty late in that fund structure, there might be an advantage to selling you off and getting out of that fund, and it might not be to your advantage, right? For the lawyers and bankers, basically the deal structures have changed dramatically over the years. There's a lot more emphasis on co-investments, continuation vehicles, the private credit market. So there's the deal sheets that you were using 5 years ago have changed dramatically. And this industry has really created a whole section for lawyers and attorneys for this practice. Family offices, if I've got some family office members here, you're no longer just writing a check to the private equity. You're actually, involved in this. Family practice ownership has increased from about 22% investment in this to about 43% investment into private equity. And for you as an individual, your pension, your healthcare, your retirement accounts are all tied into this. Even here at the bottom, towards the over 6,000 physician practices, 22% of nonprofit hospitals are private equity owned and based. Your public pension has roughly 14% in private equity types of markets. Because this is a diverse crowd, let's talk about some key roles and terms so that we start out with the level playing field. The LPs, these are the limited partners. They're the ones who are investing in private equity. These are the pensions, endowments, family offices, high net worth individuals. They commit capital to the fund. The general partner, they're essentially the PE firm, right? They raise the capital, they source the deals, they manage the portfolio. And the management team, which is where I'm coming in, we're operating the company. So the other terms here, the fund is basically they're raising a fund, again, lower middle market. They're raising a $500,000 fund to $1 billion fund with known criteria and known number of years for that. The LPs are making a commitment to that fund. So let's say an LP makes a commitment of $100 million to that fund. They're not writing out a check for $100 million. They basically committed $100 million over that life of the fund. And then the GP or the private equity will say, okay, we've got a deal. I need a check of, 10 million of that 100 million. So they make that commitment of 100 million and then they're investing along the way. They're not getting their returns back until, maybe years 5 or 6 or 7 when they start getting some distributions back on that. And we'll talk about that. The portfolio company is actually the company, the holding period we talked about, exit. There's also co-investments, which we'll talk about where it's a little bit outside of the fund. And when you think about, okay, so how does the PE make money? They make it first, they do charge a percentage, 1.5% to 2% to manage the fund. They're charging the portfolio company a management fee. But where they're really making money is at the end of the fund life cycle, they're taking 20% of the excess. So basically, once the LPs get their money back, plus a preferred return of, let's say, 8%, the next 20% will go to the private equity firm. Um, so that's how they're making their money. If you're a business owner rolling over equity um, or have an earnout, um, you need to make sure that some of the added calculations that they have in your monthly financial statements, for example, management fees that they're charging you, um, as part of that, are added back to any of those calculations because that could affect your earnout or what you get, back at the end of the day. From a PE cycle standpoint, we talked a little bit about this already, but first of all, the private equity starts out with raising money, right? They have to identify what their premises or their thesis for the fund is, um, and they're committed to raising money. They go out to the LPs and sign up subscriptions, like I talked about, commitments for that. The GP then goes acquires companies and they make a capital call. They hold and improve them. They exit and then they return capital to the LPs. Um, there's always, you've probably heard in private equity, they want to sell a company in 5 to 7 years. And the reason for that is because of the life of the fund typically. So these funds are, let's call it 10 years with maybe a 2-year continuation on that. So 10 to 12 years is the total life of the fund. They need to sell it in 5 to 7 because as they're investing in companies in years 1 through 6, they also need to start having exits because those exits are going to return capital back to the LPs. So just to give you an example, in year 5, these LPs start to receive about 0.25, so 25 cents on every dollar, they'll start to receive back in distributions. So when I'm talking about long hold periods for this, it's long hold periods. The first, you make a commitment of $100 million, you're seeing 25 cents back of distributions on paid in capital in year 5. In year 7, it's 70%. So 70 cents on every dollar. Year 9, you're finally at like about 1.2x on average. In years 12, you're about 1.6x on average. So when I'm talking about long hold periods, these are long hold periods, which is why, it's pension funds, endowments, those are your typical investors in these large deals. To give you a sense on, like, for example, in the lower middle market, where funds are about, 500 million or so, that fund will have about 10 or 12 companies in it through the life of the fund. Platform companies, not including bolt-on. And again, bolt-on companies represent about 70 to 75% of the deals these days. So it does take some time for these companies and platform companies to sell and turn over. So, essentially, if you're a business owner and private equity, you have to ask, where are they in that fund stack? So if they're in year 6, and they still have 5 or 6 companies in their portfolio that aren't sold, you have to start worrying, do they have what it takes in order to exit you in that amount of time beforehand? For the PE landscape, we'll go through a little bit of this. So private equity is different than venture, right? So venture is, very high risk, pre-revenue, early Google, things like that. This is, companies that have revenue and have EBITDA, even if they're not performing, is the private equity landscape. And it goes everything from mega and large, where the fund size is $10 billion plus, and EBITDAs are $100 million plus, and multiples are in the 12 to 15x range. The companies, funding that are the large pensions, the sovereign wealth, the endowments. In the upper middle market, you've got $2 billion to $10 billion, 25 to $100 million, and the multiples are 10 to 13x. Again, lower middle market where I'm playing $100 million to $500 million, the fund size, and 2 to 10. And then the smaller micros, you can see here. The difference is, where you're getting your capital from. So for lower middle market, a lot of it is family office runs, which is dominant high net worth individuals, and part of this emerging manager program, which allows some of the pension funds to invest in some of the smaller market size companies. Uh, so um, again, if you're a business, this is going to tell you basically where you stand and expected multiples. So if you're a business in the 50 to $100 million of revenue, you're going to be in this lower middle market, and the multiples are going to be in the 5 to 8x range. And as you move up, you're going to be moving up in the scale from a private equity perspective to core middle, upper middle, and the mega deals where you could expect greater multiples on that. It really comes down to, risk profile, right? Um, Smaller versus larger. All right, so this gets kind of to a little bit of how this presentation came to be, because again, when I first started out in private equity, 2000, 2001, it was a situation where the private equity firm was like, all right, we'll talk every week or every 2 weeks. We'll have a quarterly board meeting. You do what you do as far as growing the business. And, there was a clear separation between the two. Today, that's much different, as I mentioned, where they're really inserting themselves. And we're going to go through a little bit of the reasons why. So first of all, the way that private equity came to be is a little bit of this time chart. So this is the first 10 years, right? You had this ERISA Act. What that did is it really said that pension programs could now invest in private equity firms and funds, and eliminated some of the fiduciary responsibilities that they had. So it opened up this huge kind of pool of money for the pension programs, right? In the middle, 1996, this was just more about states not allowing registration. But the real key here, and what really opened it up, was the Sarbanes-Oxley. You guys probably remember this, Enron, WorldCom, maybe it's coming to mind. A company, not too far from here, Adelphia, $2.3 billion of fraudulent, kind of taking money out of the public company from this, set up Sarbanes-Oxley, right? So what that did is it put a whole bunch of regulations on publicly traded companies and made it very expensive and very onerous to be a publicly traded company. So now a lot of companies, instead of saying, okay, my goal is an IPO or my goal is to go public, now it's more like, I don't want to go public because there's a lot of expense there and there's a lot of scrutiny. Why don't I stay private and sell to a private equity? Also, companies that were in the market basically said, hey, look, it's easier for me to be a privately held company than to go through Sarbanes-Oxley's regulations. The other thing that happened was there was cheap credit. And when I say cheap, I mean cheap relative in 2004, 2007 to 2000 in the 1990s. Interest rates at that time came down to about 6 to 7%. And that considered cheap at the time, and that also helped fuel the growth. So you had ERISA, which allowed lots of pools of money to come into the system. You had Sarbanes-Oxley, which really eliminated a lot of the public company focus. And you had cheap credit, and that fueled leverage buyouts. And you might remember leverage buyouts in this, where they put in just a tremendous amount of leverage on the company, and they used financial engineering in order to basically go from an 8x to a 12x multiple. You really didn't have to do a lot. Again, it was like buying the right house in the right neighborhood. You got the appreciation. It was relatively new. A lot of companies getting in. Again, you had about 2,000 private equity companies back then. You have about 8,000 today. And you didn't need a lot of operating leverage in order to get there. To give you a sense, when I first started, the private equity would put in $1 debt on that company would be about $3 to $3.50 of debt. So the private equity was $1, debt was 3.5. Not a big deal as it, if everything's growing, but when you have 2008, 2007, 2008, 2009 come into play and the market starts to crash, particularly that leverage that you have really starts to come into play because your company isn't growing, right? And if you have 50% leverage on the company, you start breaking bank covenants. And that 2008, 2009 crisis is what really exposed a lot of the old way of thinking. So you had exposure of that old way of thinking of, all I need to do is, put debt on this company, grow it, and have a multiple expansion, and I'll make money for my LPs to, oh, I can't do that any longer because, I don't have the growth. Not only that, but I've got this multiple expansion because more private equity companies are coming into play, right? So they're bidding up the companies, and instead of buying a company at 8x in, 2000, 2001, it's being bid up, and now they're buying it at a much higher multiple than they were 10 years ago at this point in time. So here's where we start talking about the shift. So again, we had the multiple expansion on this. The old world, buy at 8x, sell at 12x. You only needed about 5% EBITDA growth at the time in order to make that work. The 2008 financial crisis really hurt this marketplace. You had 0% interest rate, so cash was really cheap at the time. Multiples hit a record, and that multiple expansion, really stopped being a free lunch. They had to actually get in and now create value for the portfolio companies in order to get to where they needed to be for that. So when you're a business owner looking at this and you're thinking about private equity, you have to start considering the fact that you're going to have an operating partner day one coming into your business because they do today have to create that value from day one from an operating perspective in order for this investment to pay back dividends to the LP. So it's not like they're going to leave you alone. In fact, during that due diligence process, they're coming up with their own value creation plan. And day one of acquisition, you're getting an operating partner, and they're running with that value creation plan to pay back the dividends to the LPs. So here's some of the things that I'm seeing firsthand in the middle market. And there's a huge discrepancy based on where you play in the middle market. So just to give you a sense, if you're in the upper quartile in lower middle market for PE firms, you're doing really well and you're returning, let's say 25% basis points higher than the top tier mega deals. If you're on the lower quartile of those lower market PE firms, you're only returning about 7% more. Actually, you're only returning about 3% more. So there's a huge difference between being in the lower quartile of a lower middle market and the top quartile of the lower middle market or upper middle market funds. And so if you're investing in these funds as a wealth manager, you really have to make sure that you're picking, the right funds in order to invest in because there's such a disparity between PE funds in this. So basically, this is the rise of the operating market. And what you'll see is 100% of the top 25 PE firms have dedicated operating partners. And that is being pushed down, right down through to the lower middle market. I also want you to imagine if you're in the lower middle market and you're a $50 million company, typically you don't have the infrastructure. You don't have any, you may not have an ERP system. You don't have the teams, the management teams. You don't have, perhaps you don't have a CFO. You don't have the operating cadence, and you're relying on the operating partner to bring that to the table. Well, if it's just one person, that's very difficult, right? But if you're a private equity firm and you have that bench and you can supplement that with the operating partner that you put in, you can spread that cost through 10 or 12 of your platform companies. And that's where a lot of these, so the upper middle market, the mega, firms were doing that already. Because of this change from no more multiple expansion, that model has really drifted down to lower middle market, where those lower middle market firms, when I first started, there was no such thing as an operating partner in a lower middle market firm. Today, they have a whole bench of people that when I come into a firm, they're going to say, great, Bob, here's, Devin. He's going to help you on your purchasing. He's an expert in supply management. He's going to help you there. By the way, you don't have an ERP system. I'm going to help you with an ERP system. We're going to find one for you, and here's a team that's going to help you implement it. You don't have a CFO, or we need to increase the capabilities of the CFO. We're going to put a CFO in. Not only that, but there's going to be somebody dedicated just for the office of the CFO to help with tax, to help with planning, to help with any type of nexus concerns. So you're getting now that complete push down, since you can't just do financial engineering to get at your returns. You really need to push the operating side of the equation. And that's basically what I'm seeing here, from this, over the years. Just to give you some sense, McKinsey found that private equities focus on operational value, have their improvements achieved by 2 to 3% for their internal rate of return. And KPMG in 2025 put out a report that 64% of PE firms rank margin growth as the top value driver. So if you're a banker or you're a business owner, you can count on that due diligence period being far more intrusive than it was 10 years ago. And not only that, but that due diligence period, they're really going to come up with, here's the value creation plan that we're going to be implemented. This slide, if I can get to it. So this is basically your dinner party slide, your cocktail party slide, where it's a little bit more theoretical in nature, and you're going to be able to say something and walk away 3 minutes later and look smarter, maybe. I don't know, maybe some of you studied this, but there's this whole thing about agency theory, which is how this came about. And Jensen, back in the late 80s, came up with this theory that if you're in a public companies, public companies are going to die because managers are really interested in empire building. They're interested in perks. They're interested in diversifying their businesses, and they really don't have their eye on the cash, the cash equation. And because of that, the public companies were going to be in decline. And he basically said, look, if you slap on some debt, have one owner, and make that operating partner, incentivize them with stocks and options and things like that, you will have much healthier companies and managers that are on the ball, right? And so that also, there was a lot of good things with that. There was a lot of negative things with that. This came about the whole idea of a very short-term look on companies and how they progressed. So that also helped to spur this idea of private equity, where you implement some debt and have just one owner, this GP, this private equity, who's involved in the business. Again, what happens here is, I think one of the most important things in what you'll see, particularly if you're a business owner and you're selling your company, is here 75% of CEOs are external hires. So once you sell your business, a CEO is going to step in, operating partners are going to step in. And again, as I've said, multiple times, the private equity firm is going to really be embedded in your business. And they're not, these PE firms are just no longer the financing partner or the financing arm of your model. So here's where we are today. Private equity is $8.2 trillion in business. This $3.6 trillion of unrealized value, just to give you a sense, that's larger than the GDP of Germany. This represents paper values. It's really, when I went back and said, okay, so LPs will commit $100 million to this fund, right? And they'll pay in to the fund on a regular basis, right? Whenever the GP is going to acquire a company, they'll have a capital call, they'll pay in. In the past, about 90% of the committed amount would be received into the GP or the private equity firm. Today, only about 60% to 70% of the capital committed by the LP is actually being drawn by the private equity. And there's a lot of reasons for that. One reason is because the private equity funds at the lower middle market and above are being really careful about the deals that they get into because the multiples are already so high. So they're not calling in the capital from the LPs as they did in the past. So from an LP perspective, they've got a couple things. They're not getting in their capital distributions, and they're being expected to fund the next level of funds. So there's a lot of unrealized gains here and paper gains. Also, there's 28,000 platform companies globally, about 60 to 70,000 with including bolt-on operations. So if you're a business owner, again, you've got just a lot more competition when you go out to sell your company than you did in the past. There's just a lot of companies out on the marketplace ready to be sold. We'll go through, a little bit of this. We talked about the companies the private equities that are making money and that aren't. They're really being squeezed, and there's this huge discrepancy, particularly as you go down in lower middle market, where the upper quartile is just outperforming the group in total as compared to the lower quartile of that. And a lot of the funding is coming to the mega deals. So, 40% of the fundraising is in this mega deal portion of it. And there's about a 500 basis point difference between them. So it's that K-shaped where the mega deals are getting all of the funding, or a lot of the funding, and they're also not coming out. I think after this, we'll go and have some questions, but here's the real key. Private equity over the last few years is returning 5.8% versus the market at 11.6%. So the returns really haven't been there in the last few years from that perspective. So what once was a really thriving, and you could, expect, decent returns from private equity, you're really just not getting there today. So you have much more time. Okay. Yeah, go ahead, Bill.
I'm always concerned about who's overlooking the shoulders of these organizations. I mean, the exponential growth, 8,000, and the fact there's 10 or 12 companies in, and nobody's really, my knowledge, noted. The SEC obviously is involved with public companies. So who's really watching what's going on?
It's really so a lot is the GP itself is the one who's responsible for watching what's going over on. But in order for them to get underwriting, in fact, this is also the reason that deals aren't going through because underwriting is becoming much more difficult from an LP perspective. They're due diligencing the operating teams that the private equity firm has. Um, so, you don't have the stringent SEC requirements, which is one of the reasons why money flowed into the private equity firm because these companies don't have to pertain to that. But it's really the GPs and the LPs that are overlooking it. Yeah, go ahead. Go ahead, Steve. Yeah.
Bob, I'd love to talk to you more about the people side of this equation, because I would think that the performance of these limited partner and general partner backed ventures, um, obviously they have to get their teams to perform. And so that CEO that's installed has the pressure from the general partner uh, to perform and hit targets. Meanwhile, they have maybe a disillusioned group of people and leaders that aren't real happy with the new CEO installed and don't really understand what's going on and why there's so much scrutiny on the numbers. So it's a longer answer, probably.
Yeah, it's actually not that long. When I'm coming in today, the team is, you're identifying the team and who can succeed and who can't, and you're changing out the team on a pretty regular basis because you have to hit those numbers, and you're being supplemented with the expert in supply chain from the PE group, the expert in lean manufacturing to help develop that, an expert in finance, and that's being split across all of the divisions. But improving the team, the sales side of the equation is a big one, and the operating side. The person that was promoted from shipping and receiving to your operations guy isn't cutting it, right?
That's great.
Right. Good.
All right, good. I think it's great programming on my part that the way we scheduled these in about a month, Steve Raymond will be here to talk about everything that can go wrong in private equity. He's going to tell you. Yeah, like I mentioned, he only has 3 slides. I think he's just going to stand here and tell us some stories about things that didn't go right. They didn't bring in the right expert. They didn't hire Bob Gatta to be the CEO. They hired some other turkey. So I'm sure it'll be fun.
Yeah, I've got let me just tell this to stop recording. Okay.